2015 was a very good year for us. I don't think it was a good year for a lot of people, but fortunately, we were disciplined. And so at the start of the year, when everybody was greedy, we were quite fearful. And then when everybody became fearful, we became greedy. And we had the wherewithal to do that. So we took a lot of flack at the beginning of the year when we maintained our discipline and found that everything was too expensive and the risks presenting themselves were very challenging. We had higher cash content, and most people remember that we even took a very controversial put position, which ironically stood us in excellent stead during the year. Not only because it made us a lot of money, but also because it kept us psychologically whole so that we had the courage to deploy enormous amounts of cash when everybody else was fearful. We're very, very proud of the fact that we maintained our unblemished record of preserving everyone's capital. So as at the end of December 2015, every single investor at every single entry point has made money with us. We had a great year, recording over 10% drive away, no more to pay for our investors, with quite low volatility. Right, so the last quarter was a bit of a Jekyll and Hyde story. We started off when everyone was still fearful, deploying a lot of cash, and we found some great bargains. Paradoxically, everybody then got greedy again. It's funny how that greed and fear button gets switched both ways. And we actually let quite a few of our positions go, so that we finished off the year with almost 20% in cash. Some of the things we sold was our long-held Fox holding, and we both sold Duet when everybody was quite greedy, and then bought it back at much lower levels. Yeah, the current portfolio positioning remains very defensive. A lot of people think it's quite boring. That's okay, I like boring. Almost half the portfolio is in toilet paper and toothpaste type companies, which has generally been our trademark. But we do have some interesting exposures to both some second tier financials and some discretionary retailers, where we think they're very well positioned, and we were able to obtain those holdings at very attractive prices. Some examples would be Credit Corp, SG Fleet, even Macmillan Shakespeare, and then on discretionary retail, we've got really big positions in RCG Group and the controversial JB Hi-Fi. As we always say, we don't know what the market's going to do. We like to think we know what individual stocks will do in terms of the cash they generate, and that's what we focus on. But I do think, as always, it'll be a stock picker's market. I think that disruption is rife, and more importantly, the strong are getting stronger. So corporate Darwinism is alive and well in Australia. So we, more than ever, we're focused on buying good, strong, resilient businesses run by competent management, and our discipline is being maintained where we have to buy them at the right price. So look, January has been interesting. For us, it's been quite good in that we entered this period with 20% in cash. So when I got back from holiday and found everything on sale, it was wonderful to pull out the checkbook and start buying things. We also paid a very nice distribution to our clients of about 3 cents per unit. So some clients got worried that the unit price had dropped by that 3 cents, but they've received the cash. So that should be taken into account. I don't think we'll end up the month positive, but with the market down about 6%, I think we'll be 1 or 2% down. And the portfolio is stronger for this clean out, and I look forward to a very good year.